This is a story of two friends way back in the year 1987. They happened to pass out at the same time, obviously. They joined the same organization coincidentally. They were obsessed with the idea of passive investing in an era where active investing was the only norm. This was a time when the Indian entrepreneur did not have access to the funds, the capital that he has today. It was just an idea and a massive leap of faith.
Millions invest differently today because two entrepreneurs reimagined investing yesterday. The men behind India's ETF revolution, Sanjiv Shah and Rajan Mehta, only on MF Chronicles.
We had two philosophies when we started off this venture. One was the investment philosophy that it's very difficult to beat the markets. The second philosophy was really of the distribution. Can we come up with a product which is basically believes in investment philosophy of indexing and also believes in the whole concept that basically the principal agent problem can be solved.
Even today, when you talk to people, they're more inclined to getting into an actively managed fund. And I can personally tell you that there are so many amazing ETFs and amazing index funds. Why do you think that is happening? Why is the narrative still not going the ETF?
What we have seen over time that intelligent money goes for ETF. Like we have seen one of the very popular active manager used to have a big position in ETFs. They know from their international exposure that what's going to work in long term. Smart money is coming to ETFs.
I'm just smiling at the word smart and intelligent. You're treading on eggshells here. Hello and welcome to another episode on MF Chronicles. I'm going to start by telling you a small story. This is a story of two friends way back in the year 1987. They were doing their MBA, their MMS from Bombay University. They happened to pass out at the same time, obviously. They joined the same organization coincidentally. They worked there for a few years and then the entrepreneurial bug hit them. The entrepreneurial bug hit them around the year 2000-2001. They were obsessed with the idea of passive investing in an era where active investing was the only norm. Cut to 2001 when they launched the first product, which was, by the way, a major leap of faith. It came in the aftermath of 9/11. This was a time when the Indian entrepreneur did not have access to the sort of funds, the capital that he has today. It was just an idea and a massive leap of faith. I'm talking about the two promoters of Benchmark Asset Management, Sanjiv Shah and Rajan Mehta. And I'd like to, use a pun here. They are the OGs of the BeES Gs, Benchmark Exchange Schemes. So, welcome to the show.
Thank you.
Sanjeev and Rajan.
Thank you.
It's indeed a pleasure, and I must confess by telling you that we've all seen Benchmark's growth from outside. I've been part of the active management space, and it has been a mixture of awe and skepticism. It was a very different scenario out there, and to even think of something which would buy the market and not beat the market was something not very, what is the word I'm looking for, acceptable to the world at large. Let me start off with the first question, Sanjeev, I wanted to ask you. What made you gravitate towards this whole idea of passive investing? Was it दिल से कि एक philosophy है life का ये करने है, or was it दिमाग से कि ये एक open wide space है, कोई नहीं देख रहा तो हमको देखना चाहिए?
So, dono, I would think. So, let me put it this way. So, we had two philosophies when we started off this venture. One was the investment philosophy that it's very difficult to beat the markets. We had all the research and which was going through and all that. We went through a lot many more, if I used to head derivatives before we launched our venture. And you could see that basically it's very, very difficult to beat the markets. The market has all the knowledge and it really imbibes all the knowledge. Anybody who says that they can actually beat it is very difficult. Even if you can do it 1 year, you can't do it consistently. The second philosophy was really of the distribution. We always believed that basically we have a principal agent problem in the mutual fund space, wherein basically the intermediary is really in a sense should be the agent of the investor but he ends up being the agent of the producer, which is basically the mutual fund. The incentives are completely misaligned because of that. So the selling itself becomes misaligned. And that was the second philosophy. We said that basically, can we come up with a product which is basically believes in investment philosophy of indexing and also believes in the whole concept that basically the principal agent problem can be solved. So we did a lot of research. Rajan actually had the experience of using ETFs. And given the Indian condition of the exchanges really becoming big and having literally terminals from Ladakh to Kanyakumari, we thought this makes imminent sense, and that's why I embarked on the whole concept of the ETF. That was if you want to call it, the genesis.
That's very interesting that you mentioned that. He was saying that you had some exposure to ETFs before you started off with Benchmark. What was the sort of exposure that you had to ETFs?
So we used to use for my client's portfolio when I was in Meredith, London.
Mm-hmm.
And I used to study the actual evolution of ETF. So it came earlier as a Morgan Stanley had called something called Webs earlier. Then the Spider came, and slowly the entire ETF industry evolved. And the structure was very fascinating. So we were chatting regularly, myself and Sanjiv, and then both of us kind of liked this idea. And we thought that it's going to take a long time to develop. So only way we can implement is when we have our own company, where we can sit, be patient and nurture the entire concept and then reap the benefits when it becomes big. So that was the reason why we implemented it as an entrepreneurial journey, because both of us were working in Merrill Lynch that time, and we could have told our bosses or somebody, but we thought that there would be a lot of bureaucracy in that.
Interesting, because you mentioned about Spider, and I think about the global landscape at that point of time, very little was known about ETFs beyond US, I think a few other countries, if my memory serves me right in that point of time. So when you were studying ETFs, when you were exposed to ETFs, do you think that there were any fundamental structures in India that could eventually follow the route and give the sort of tailwinds to the ETF industry when you were studying these global ETFs?
No, in terms of tailwinds, we always had a conviction it's going to work in long term because of the reason what Sanjiv mentioned. So only we didn't know that how long it will take and what kind of efforts will be involved. So that's why we kind of plunged in and took entrepreneurial route to introduce that.
So let me add. So this formation of the National Stock Exchange, which used technology to ensure that basically you are there everywhere in the country, was one of the big drivers in our view the ETFs would succeed. Because if you're a small town, forget what happened post 2000 and because of the apps and all that. I think it's the same journey which went through. You could actually go to any small terminal and actually buy it. You were not limited to the IFA or the bank coming to you and doing it. So even if you're a very, very small investor, we thought ETFs worked the best. So that was, we believed, were the tailwinds. And as Rajan said, we were not sure as to how long this tailwind will actually help boost up the whole product. But our thought process really was that, basically the Indian market is really structured for ETFs.
Fascinating, because I think the NSE part makes a lot of sense, because essentially ETFs are a broking product on the mutual fund platform, right? But equally fascinating is the fact that at that point of time when you launched it, there were less than 1 crore demat accounts in the country. Yeah, not what we see here today. Investor education was just about starting to pick up. And I think we're just about coming out of a global crisis, the .com bust. So fascinating. So do you think that ETFs in India were held back more by lack of awareness? I mean, there was a very profound, very, very prolific, that's the word I'm looking at, prolific narrative going on for active management. Was it something that was really holding the growth of ETFs at that point of time?
I would say awareness, definitely we didn't spend tons and tons of money on advertising, but we did really go out and met brokers and all that. If I were to say only one reason, I would say it is really incentives.
Incentives.
One of the reasons we always thought that basically, I told you about the principal agent problem. We thought that ETFs will actually solve it, not realizing that basically the entrenchment of the agent is so high that basically to break that is not so easy. When the agent is actually getting a lot of money from the product provider, and even though he's the agent of the investor, his incentives are misaligned, if you want to call it. To align them is not so easy. We needed a lot more awareness, and we knew that it's going to take longer than the normal times, but it was much longer than we thought. But that was if I had to pinpoint one reason, I would say the whole misalignment of incentives to the intermediary.
So same problem in mutual fund agent also, it was in broking industry also, because they were trying to recommend stock which are volatile, so which can increase the brokerage
The
income.
churn and all.
So that also it was some kind of resistance was coming.
Okay. So given that scenario, when you are saying that the incentives are misaligned, what was the TAM, the target addressable market, that you had in mind which you were going after?
Honestly, we thought the whole market.
Whole
Any
market.
demat account. We really believe that and to be honest, the number of folios in the mutual fund space were actually lesser than a demat account. The reality is basically, if you look at the amount of people who basically really use the demat accounts, and there were multiple demat accounts. So if I had a demat account, I would have one with my wife, I would have one with my parents. So really speaking, the number was much smaller. But given that, our view was that basically the whole demat universe is our field to play.
That's quite interesting because, when you're talking about the target addressable market, see, everybody starts off like that, right? I've talked to several multinational companies and they come and they say, India is, 100 crore की जनता है, and then इतना टूथपेस्ट एक आदमी लेगा तो इतना बड़ा मार्केट है तो वो होना चाहिए. So that's the target addressable market. But eventually you have to slice and dice and realize where you want to focus on. So what realization came to you after a few years that where did the TAM actually reside? Considering that you had some customer feedback, you had people already starting to experimenting with ETFs and you had to run a business. So which was the segment you really focused on?
So eventually our real growth came in two areas. One was the institutional market, where, basically we saw institutions wanting to take positions in specific sectors actually come in aggressively. So that gave us a boost. And our real retail boost, believe it or not, came from gold. Because, Indians are gold buyers across the board. And I'll give you one very interesting insight, which we found, after we launched the gold. We think, the people who buy gold are, just savers who don't understand investing and all that. What we saw in our gold ETF was that whenever there was a spike in buying gold, the rupee actually depreciated 2-3 months after. A very interesting insight.
Interesting.
So basically Indians were much more savvier than what we all, especially the small gold buyer, is much more savvier. So if you look at hedge for a small investor, what's the hedge? The gold. So to answer your question, really speaking, on the retail side, it was really the gold which took off for us. And then on the institutional side, the specific sector ETFs took off. Post that, if you look at it, we'll talk about it, how the market grew 10 years from there. Especially post-COVID, it's really taken off.
Please continue.
No. So if you look at it, basically we analyze that basically gold works, and because gold works, we came up with the idea of. I'll talk about liquid a little later. Where Rajan can talk about that. But the reality is basically, if you look, we went to the government of India and said basically, you're holding stock. This stock really belongs to the people of India. You want to divest. There is a problem in terms of divesting because, basically strategic divesting is becoming a bad name.
Correct.
So we gave the concept of a CPS ETF. It took us about 4 years. That was again, a large boost to retail market because we did a lot of advertising, and Government of India being Government of India does make a big difference. So that plus gold really took off. And I think what happened in 2000 was people, the whole ecosystem developed quite substantially. If you look at the brokers, be it Zerodha or Grow or whatever, people actually were at home and they could actually transact very easily. And when they were transacting, the younger generation realized that basically, buying a specific stock is not taking me anywhere. I want to be invested. I better invest in ETFs. And that's, I think, the real drive where, ETF came around 2000, 2001, post-COVID, I would think.
Interesting.
Also, just like to add, then gold, what happened was, like after us, so many AMCs launched the gold ETF product, but everybody had the similar product. So that templatized our product and they copied everything, which helped in a way because it got standardized, the product, and everybody was talking the same language, and that expanded the market. So even though we got more market share came down, but overall AUM went up because of that.
Yeah, in fact, I think then the gold index funds came in. आपके पास डीमैट अकाउंट नहीं है, आप उसमें डालिए, SIP शुरू हो गया, fund of funds started coming in. But since you talked about gold ETFs, I think that we were at Benchmark, you were the first ones worldwide to launch a gold ETF.
Filed the offer document. So we filed in 2002.
Okay.
And then what happened? We started working with World Gold Council.
Okay.
To get the support in popularizing and all, because they do support gold-based products. So they were kind enough to support us. And what happened was the gold being subject of multiple regulations, like RBI comes in, then FMC was there at that time, they come in, and then we were probably going round in circle because SEBI, rightly so at that time, when we wanted to be all the regulators on the same side, so there is no problem later on. And that took a lot of time. And the WGC saw the merit in the product, and then they started in Australia first, and they launched in the US. And now it's like $550 billion product. It's $500 billion are there in gold ETF.
We actually thought about patenting it, but didn't do it.
Yeah, didn't go.
Yeah, that's the learnings of an entrepreneur, right?
Yes.
Very interesting. And I just think if you can give a couple of more minutes to explaining what happens on the back end when you launch a gold ETF. I'm buying a gold ETF. So I'm buying units of a gold ETF. So in terms of physical gold, how does it work? Our viewers would be very interested to know about that.
So it's very simple like other ETF. So all ETFs have in-kind exchange when units are created. So here the market maker actually sells the gold ETF unit in market and at the same time purchases the actual bullion.
Actual bullion, okay.
Okay, his name. And then what he does is at the end of the day, he comes and says, I want to create so many units and I'll give you this bullion bar to our custodian. So we don't go in as a ETF, go in market and buy gold, but it is given by market maker to us. And redemption, exactly same thing in reverse manner. So they give us the units and we give them the bullion bar.
It's a very naive question, but I think most people will want to ask, where is the gold stored?
Gold stored with custodians.
Vaults are there.
And it's all approved by SEBI, the arrangement.
So, to just conceive and think and implement a product like this, I think it's fascinating.
We were very lucky to have, some friends who have in bullion market and advising us and, introducing the right people in the market. Yeah, and so that was really helpful.
I remember an entrepreneur friend of mine who once said, the harder you work, the luckier you get.
Sure. Yeah. The other advantage I think we had was, basically our idea was to make investing in gold simple. And, we actually went with the concept that basically if I'm a investor, how do I make life simple for you? And fortunately, everything fell in place. And good thing was that basically, remember, there are two markets. One is the gold market and one is the equity market, the exchange.
Exchange, correct.
And what is happening is basically, you have to marry both to an extent because, basically the market maker has to straddle both the markets. And fortunately, around that time, the government also knocked off all the duties and become easier. There were duties, but much more easier to import and actually, make markets. So, everything fell in place, if you want to call it.
Very interesting. I'd just like to circle back to the point you were talking about the institutional piece taking off. I would want to believe that one of the triggers which eventually happened for the rise of subscription to ETFs, apart from knowledge, awareness, etc., was also the fact that when you're buying an index from a mutual fund, I think the benchmark was total returns at that point of time. Well, it was not total returns at that time. It was not total. It was price index, right? So the outperformance used to be a little better than what it was.
The dividend yield, there was the outperformance.
So on one hand, you started using the total returns index, which compressed maybe the large cap fund returns. On the other hand, you started having direct plans, which brought down the cost. So I think there was a section of people who said that, boss, if this is going to happen, my returns are getting compressed and, I can get a direct plan at a lower cost. Why can't I go to an ETF at an even lower cost? Because ultimately the whale, most of them were buying the market in a large cap space. Yeah. Would you agree or disagree with the statement?
No, agree. So what happened was basically we actually went out and really kept telling people the difference between a TRI and a price index. In a sense, it was falling on deaf ears, if you want to call it, because the incentives, as I said, was misaligned. But when also as time passes, the whole technology of internet and everything, information dissemination becomes so much easier, and then people started realizing, look here, I mean, the analysis being done here is different from the reality as it exists. So then people started talking about it, and that's how basically. And then when SEBI forced the issue on the mutual funds, it became glaring. So that was but I mean, I think it's the process of evolution of each market, and that's how it happened. But yes, you're right.
And the whole evolution, I was in the mutual fund advisory committee at that point of time when direct plans were introduced. So that itself was a big sort of introduction. And then this, despite all of this today, we still see, okay, let me just frame this question differently. If you look at the overall AUM and you strip away the contribution which is coming in from the institutions, and that too in the Nifty, more or less, or in the Bank Nifty, and you look at the remaining portion, there are tons of indices right now. There are tons of ETFs right now. Yet, even now, and I'm taking all gold also out of it for the time being because that's not a conventional ETF from an equity point of view, the narrative is still so aggressively active. Okay? Your argument about incentives being misaligned has probably diminished over a period of time with direct plans coming in and all of that. But even today, when you talk to people, they're more inclined to getting into an actively managed fund. And passively managed funds don't really come into their mindshare. And I can personally tell you that there are so many amazing ETFs and amazing index funds. Why do you think that is happening? Why is the narrative still not going the ETF way?
Again, I would still point out to the issue that basically the intermediary is driven to talk about the fact that basically active, because there are two parts to it. One is basically you can create narratives. Humans, when they invest or do whatever, they go after stories. Active manager can give stories. A passive manager can't give stories. So that obviously is one part of it. Second is basically when you're investing, and which is changing now because you do see a lot of direct investing through large apps and things like that, where basically people are investing directly. But still, people, especially at a later age, want to have somebody to hold their hands. And the one who's holding hands obviously is disincentivized to talk about active. So I think these are the 2-3 things which still drive. But my view is that basically if I look at post-COVID, the growth of in the retail space of passive and ETFs is far, in terms of percentage, is higher than active, if I'm not mistaken. But I don't have the data to back it, but I think it is so.
I agree with that because luckily now this entire RIA channel has opened up, but still it's in infancy. Like practicing RIA as we talk is around 700, registered 900. And total fee as per statistics is 1,000 crores only compared to the distribution commission which runs huge. So that is still a nascent industry but growing industry. And then what we have seen over time, that intelligent money goes for ETF. Like we have seen one of the very popular active manager used to have a big position in ETFs that time. And also very smart, the large software entrepreneurs having position, because they know from their international exposure that what's going to work in long term. So that smart money is coming to ETFs.
I'm just smiling at the word smart and intelligent. You're treading on eggshells here. I like that, but and I would tend to agree in some parts, because when I see the market out there, I think there's acceptance for alpha. There is aspiration for alpha. Everybody wants to talk, be coffee table conversations about alpha, and there's more of an acceptance for passive. कि मैं और कुछ नहीं कर सकता तो मैं passive कर रहा हूँ. So I think that narrative is still,
because everybody loves stories. So active management has one advantage of stories besides the fees, but they have but I mean, I think people eventually realize that basically I'm putting 100 rupees 20 years from today. Will that 100 rupees be better off in a passive fund or an active fund? I think that realization is slowly coming in, and we are seeing more and more, at least DIY investors going into passive rather than active. You still see all this, if you want to call it the new age investing sites. They give a top 10, top 5, because they need to basically bombard you with some information. But as is happening in the US now, I think if I'm not mistaken, in the US 50 to 55% of all investing is now passive, if not more. So that will happen here also. As we talked about, it's about 25%, but I think, it'll slowly
This
move to that.
dichotomy is the same as spiritual world also. People know it's Maya, but still people going after worldly pleasure.
Yeah, true.
मिलने नहीं वाला है मगर जाना तो है.
No, but I just want to talk about the story part a bit more. And it's fascinating. For example, a large section of the media a few years back carried a story about how actively managed funds were unable to beat the mid-cap index. It was very widespread, and I think it caused a lot of acrimony amongst the active fund managers. And the story they pushed back with was that there were 2 or 3 stocks in the mid-cap index which were driving it. Otherwise, they were doing well. Okay, so वो उसके बाद मेरे को passive का pushback ही नहीं दिखाई दिया. So this is a constant story of narratives. You push back here, and this was just taken, accepted.
For passive, the data will talk for itself. Nobody has to push. For passive, the data will talk for itself. Nobody has to push.
It's boring. It's anodyne, if you want to call it, but it is what it is. So stories will work. Stories work for a time. But then people start realizing, yeah, bhaiya, as Rajan said, Maya hai. let me go to what really works. So yeah, I mean, until we really have proper intermediary regulations, which are, I would say, I don't know, SEBI had come out with a, kind of a draft paper. Then there was 3 years back, not the latest one. And they asked for the fact that basically, give some opinion and all that. And I think a lot of people give the opinion that basically the intermediary incentives are completely, out of whack. And but I think the pushback from the system was very high, and that never happened.
No, honestly, I think that's a damn good narrative the passive industry does, that the intermediary incentives are misaligned, because there's some truth but not the entire truth. And I'm now on the other side.
So one is the incentive in terms of money. And secondly is the reason for existence. If like say, if I'm advising my person as a passive, so he will ask what value you are adding.
Correct.
So that's a problem, because
Very good point.
Perceived to keep on adding value.
Very good point. You don't seem to be adding value if you're
like
very good
point. But otherwise I'll do fund measure selection. This guy's done well.
Excellent point.
This guy is a value. This guy is growth, and there's a growth market. All this narrative has to be told to clients. So at least you are adding some value.
Very interesting. I'm just thinking aloud. You started the whole ETF revolution, okay? If you were around today, you would have actually changed the narrative, or at least taken charge of the narrative. In the last 10 minutes, this sort of pushback I am getting for all the things I'm saying is fascinating. Why did you move out? I think this would have been the ideal situation for you.
Sure. Remember when we started off, we talked about the fact that capital is an issue. Then if you remember, SEBI used to have a minimum
10 crores.
10 crores. That time 10 crores was huge. So obviously we had to have investors. Now as any investor wants basically a return after. So we hung in there for 10 years. And we wanted to actually be the people who we still hang around. But the SEBI rules didn't allow us to be. There's a concept of sponsor. So if you have a PE fund who wants to be a sponsor, that time they were not allowed.
That time they were not allowed. Now
I think they're now coming up with some ideas to do it. So we were stuck in the composition of the capital, where we didn't have a choice. The investor had to get out. And then, basically we only could do a strategic sale. So such is life.
Also,
we were believers. We never wanted
believers
to actually...
and the kind of names who were coming and talking to us, to buying us without we approaching them, was really like our shareholders were really kind of getting excited and attracted. And finally, when Goldman Sachs came, but they thought that, it will be very good for them. And just to tell, like in hindsight, nobody knows. Like we are saying that everything is grown bigger and all, so everybody's wiser in hindsight. But so that time, as Sanjiv mentioned, we wanted to go with the shareholders because they've supported us when we were nobody. We never did any pitch deck or something. We just spoken, and they were willing to kind of put in money and give the sponsor vehicle. So we just couldn't resist, not resist, but it's very...
No, and secondly, structurally also it's very difficult for us to get a PE. Now, fortunately, at least SEBI is thinking about it. It's still not there, but SEBI is. So, one of the things, we actually had gone to SEBI and told them that, please allow us to have a PE investor. Now, that time, it was been a long process. And to be fair to investors, you hang in there for 8, 9, 10 years. I mean, you also obviously return. I mean, to look at it, basically, if you look at our fund, which moved from one to the other entity, today would be the 10th largest AMC. Just as a AMC by itself.
Let me absorb this for a second. If the whole BeES
Yes.
universe would be the 10th largest AMC today.
Yeah.
Fascinating.
So it is what it is.
Fascinating. I mean, just to...
And in a way, it's like we feel left out or something, but at the same time, there is satisfaction that like when you raise some kid and somebody adopts and raise them well. So all, credit to all this Goldman Sachs and Nippon to look after that business and give the right kind of incentive to grow.
It's ironic that a product, an AMC which was born out of the idea of the capital markets, actually had to sell off because of lack of capital.
Because of the structure of the capital.
Because of the structure of capital. Okay.
Yeah.
I mean that.
So to be honest with you, there were a lot of PE guys who were interested, but they wouldn't have been allowed to become sponsors. So it became, but it is what it is.
Correct. So again, coming back to product innovation, liquid BeES was something again which was a masterstroke in hindsight. What was the thought process? What were the conversations around the time you thought that you would want to launch liquid BeES or a product like liquid BeES? Take us through.
So because we were marketing Nifty BeES, we were visiting a lot of brokers, telling them to recommend to customers, and that kind of gave us idea that there are some systemic problems. So SEBI didn't want too much money of investors to stay with the broker because broker were using for margin funding at that time. And broker never wanted to ideally trade without having money in the account of investor, because then, if trade goes bad. So it was very loose structure earlier. So we thought that can we solve this problem by having, kind of money in the Demat account. So that's how we started. It was a simple idea, but required a lot of changes in system because we wanted to make it daily dividend product because the NAV remains constant. So at least everybody can kind of calculate number of units of the hand. And to do that, because daily dividend in account statement kind of system is very easy because the accountant creates and you create account statement. But doing in Demat, every day you have to do corporate actions and those many units has to go. So the concept of first daily Ben post came, and we were quite fortunate that we get a lot of support from depositories for all the innovation. Secondly, we have to waive off the Demat charges on that. Thirdly, we have to convince all the brokers to waive brokerage. So it was a long and arduous journey to implement this innovation. But ultimately, people found useful and they started using it.
So to add to that, it's very interesting when you look back, because if you look at it as liquid BeES is really being outside the banking system. The whole idea was that basically, you're in Dibrugarh. The conversation between a broker and a client would take 7 days money flow, and that became a problem. So as Rajan said, BeES wanted to solve that problem. But when we look back, we didn't realize at that point in time is that basically we're actually disintermediating the bank. Now, if you look at stable coins, if you look at the whole concept of blockchain, it is the same thing.
Same thing.
It's just that the depository was the kind of the blockchain mechanism, and obviously what's going on, which is thing. But that was the concept. And funnily, we actually got a huge pushback from banks. Because basically margins, we got the approval for liquid BeES to be margins to be paid for derivatives and other things. So the Indian brokers did it, but the foreign entities could have done it. The custodians really fought back
because there was a float income.
They would have lost the float income. So that was a fascinating part of doing this. So when we look back, the uses of liquid BeES, we only seeing it in hindsight, were much more different than and that's where the world has moved, disintermediating the banks. So that gives us another satisfaction. We may not be there, but at least we did something which is totally different. Again, first in the world.
Yeah. In fact, I think one of the new age AMCs which has just come in, they've just crossed 10,000 crores primarily on the back of a liquid ETF, right? Some innovation which they...
CEO used to be our fund manager.
There you go. There you go. I hear a lot of stories. People come and say, मैंने इतना SIP किया, मैं इतना पैसा जमा किया, तो ये मैंने घर खरीदा है. There are if you go on Twitter, there are so many people who said that this house was because of this particular mutual fund, or I did this because of this particular mutual fund. What are stories you hear when you look back? Anybody who's come and talk to you, कि I got this done because of passives, I saved so much of money, I built this.
Gold, I think a lot of people come and we could invest in gold. We wouldn't have invested in gold without gold ETF. And right now it's like everybody's so saying gold. In fact, the gold BeES and silver BeES are the top traded stocks across all the stocks now. So it's like ETFs are the most traded securities now. Yeah, so that's what people say. In fact, there are some couple of other very humorous incidents happened earlier. So when we were marketing, so one day suddenly call comes from Agra. I'm calling from Agra. कि साहब ये बताओ कि निफ्टी बीज में 20 स्टॉक कौन से हैं?
20, okay.
So, people, so India is very peculiar.
Yeah.
Another interesting story was when we were marketing gold ETF and we were explaining that gold in Demat account and all. So in Delhi, one gentleman asked question that मेरी बेटी को मुझे दहेज में देना है कुछ, तो ये ETF में बेच के फिजिकल ले सकता हूँ मैं? So before I answer, somebody says, तू पागल है, तुझको फिजिकल गोल्ड क्यों देने, और उसकी सांस खा जाएगी, तेरी बेटी के नाम पे रख डीमैट में.
Nice one, yeah.
So it's people really come out with interesting anecdotes.
Yeah, I agree with you. I think in hindsight, you look at the use cases, they just give you that much more encouragement. Yeah. You talked about the banking system and the pushback you got from the banking system for ETFs. I think this is after a long, arduous journey in ETFs. I'm very curious to know, when you actually started off ETFs. Now, everybody understands what ETFs are and everybody knows, unit for stock or unit for gold. But उस समय जो आपको मार्केट मेकिंग का सिस्टम, लिक्विडिटी का सिस्टम क्रिएट करने का था, आई वांट यू टू टेक अस थ्रू दैट जर्नी वे बैक इन द डे जब आप लॉन्च कर रहे हैं. आपने कैसे यू pieced all of these pieces of puzzle together to create this whole and I'm telling you this from personal experience. We found it fascinating sitting on the outside. Way back in the day in 97, we had launched a cash fund, a liquid fund. Okay. उस समय आपको याद होगा वो स्प्रिंट फैक्स था और ये था और वो था, तो 5 दिन का रिडेम्पशन को हमने 2 दिन का रिडेम्पशन कर दिया था, T+2, और उसमें भी हालत खराब हो गई थी. There were so many things we had to streamline. Just a few years later, you create an entire ecosystem, okay, of stuff which probably the mutual fund industry is not heard of or not heard of enough at that point of time. How did you conceptualize? How did you think through this? The back end part of it, I would like to know.
So that was the most critical component because basically you're on the exchange. You have to ensure that basically the person who's coming on the exchange is getting the right price. Otherwise, basically the product fails. It's very interesting. Our IPO, we only had 7 investors.
Only 7 investors?
Only 7 investors.
Okay.
They were all market makers.
Sorry?
All market makers.
Acha.
So they all invested, I think, if I'm not mistaken, about 3 or 4 crores
3 crores each.
So it came to whatever, 20-25 crores. So they were the only investors. The whole idea was that, we never marketed. We said basically this is how we want to actually go out to the market and say when you come to the market, you will be able to get the right price. We actually spent a lot of time going to this market makers. They typically were traders who basically were, making markets in, individual stocks. And to some extent, they were in the new derivative world, they've become the derivative traders who were doing arbitrage. So we actually convinced them that basically, look, this is a new product and this really makes sense for you. Because, we devised a system wherein basically they could buy the underlying 50 and, do the ETFs, Nifty BeES selling on the market and vice versa. And that took a lot of time for us to basically develop and ensure that basically, we are providing end-to-end solution to the market maker, which is a broker. And first we did that and then only we launched the product.
Also, one of the key responsibility of fund manager is to see whether the prices are in line or not of the ETF. And if suppose something go or just call up market maker and just say that please come in and give proper price. Also, another unique thing which was developed in India because of very peculiar situation is called cash creation.
Cash creation.
Yeah, that was very unique. Like we developed in India.
Okay.
Where, for institutional buyer, you can create a different kind of creation metrics.
Can you just take us a little bit more through that?
So it's like instead of in-kind exchange, it was like trades were implemented as if some market maker is doing, but the fund is doing that. And everything remains same.
So essentially, the market maker is somebody who will give you two-way quotes, right? So I sit with an inventory of units as a market maker, which I would have bought from the mutual fund, right? So you want to sell, you want to buy, I will give you two-way quotes. And as a mutual fund, you would want to ensure that it's streamlined, is as close to the price as possible, it's as efficient as possible. Did I get that right? Correct. Fascinating. And the amount of conviction that you had, did it get translated into people that, okay, I want to learn about this, I want to get it done?
Oh yeah. Market makers were really keen. They really went into it. So obviously, one of the things we had to do was ensure that basically there were more investors coming on the counter and keep buying and selling. It happened over a period of time, slower than we thought, but it happened. So I would say that the eagerness and the enthusiasm of market makers when we actually started was fantastic. The Indian brokers were really at it in terms of okay, there's something new, let me learn.
Also, another interesting thing we introduced for investor education is something called real-time NAV. We were the first one to give real-time NAV, indicative NAV of all the ETFs. So when investors are trading, they can actually compare, like the price is off or on.
Okay, so I could see the index and I could see the NAV at the same time and compare the efficiency of
ETF price and the ETF NAV.
ETF price and the ETF NAV. Okay.
So that you're not paying too much high or too much, you're not selling at a lower price.
Oh, that transparency would have definitely created a lot more comfort.
Yes.
Very interesting. I just wanted to understand from you, Sanjiv, you were instrumental in getting organizations like EPFO coming in and investing in, right? You made it sound very simple, that this is what I did, this is what happened. What mindset did you have to change for government organizations? Because these are behemoths, yeah, and these were very big.
The first one was actually get into equity. That was a big change because the volatility of NAV becomes a big problem for the government. But I think what happened was, as we go along, even the government and the bureaucrat also started understanding that the real returns are now coming in equity, and if we have to promise returns over a period of time to investors, if we are only in debt, we will not be able to provide this, and basically we'll get into the same situation what we had saw it in UTI 64, where basically the corpus will not be able to manage it. So I think they were with the idea that basically we have to invest in equity and we have to get better returns, was something they was playing in their mind. So that and what we went and explained to be honest with you, that time the whole machinery of Goldman Sachs helped, because we gave a lot of examples of the in other parts of the world, and then the whole concept was accepted by the board that we should invest in equity. And then we went to convince them that basically if you're doing equity, please do not do active, because then it becomes a big problem in terms of not for yourself but also for the end investor. Why this fund, why not that fund? Make sure it invests in index. And that's how the concept of we were able to sell to them that you should invest in ETFs.
This was in which year?
This was around 2013-14. And they started investing in 2015-16, if I'm not mistaken. But it took us really 2 hours and about nearly 7-8 meetings with the board of the EPFO to convince them. And as I said, basically we had heavyweights from Goldman explaining why this happens, how it happens. And fortunately, at that point in time, we were also talking to the government about the CPS, ETF and all that. So we got the weight of the Ministry of Finance also, coming in saying, look, let's look at it much more openly and positively in terms of how to basically go about it.
Interesting. So
I think what is very inspiring of this change is that impact reached out to so many people, because if added like 1%, 1.5% of returns of the Provident Fund, so many people benefited.
So think about it. ETFs are now held by not just the people who have demat accounts. It's also held by the people who are actually investing in EPFO.
very profound. Very profound. Very interesting. In fact, here's a statistic I can share with you. When I was doing the ETF and indexing white paper, one of the statistics which came up was that two things contribute to an inflection point of the ETF growth in any country. One is a minimum of 10 to 12 years. Actually, the median is 13 years. and the second is the entry of institutions.
Yeah.
And I think coincidentally, the time frame you're talking about and the manner you're talking about was just set the base for the inflection of the mutual fund industry. Fascinating. So let me just now push you back a bit on some of the narratives which are coming in for passive. Okay, not exactly passive, but passive investing, saying that there's too much of money chasing passives, and that is actually distorting stock prices. There is an argument, for example, that a particular category of mutual funds is getting so much of SIP, so that is distorting prices. Simultaneously, it is also the fact that a lot of money is getting into some indices which is pushing up prices. What is your response to an argument like that?
This is very kind of worldwide debate which is going on, but the people don't understand the simple fact. Even though the flows are coming in passive, so maybe passive may be X percentage of total AUM of industry, but when you look at the trading, passive is much smaller because passive doesn't trade, but active people keep on trading. The price is actually really influenced by the people who trade in the market.
Okay.
So this people give excuse that because of passive is flows are coming and I'm not able to perform, some stocks are going up. I don't think it's right, because there are still enough people out there who can, like, if there's a mispricing, they feel they can go short, they can do whatever.
No, let me just clarify this point. The point is that because there's a relentless amount of money coming in indices, okay, you're buying at any price, which is not actually reflecting the right stock price at any given point of time. The same argument is for active in SIPs, that is for passive in indices. So
let me put it the other way around. That means basically what people are arguing is that basically you're artificially inflating a price of the
in
top
a manner
50
of speaking,
stocks,
you could say
100
that,
stocks
yeah.
or whatever. But if you're a smart active manager, you will see that basically this particular price is inflated. What will I do? I can easily basically buy stocks which are undervalued and basically outperform the market. I haven't seen anybody outperforming the market. So that that argument itself goes for a toss.
That's a good pushback. Yeah.
So that's number one. Number two is basically also, if you look at it, and this is corollary to the same argument, that if you look at the large cap active funds, if you look at, they're really index huggers. So basically, they are also the guys who basically, when they get the money from the SIP, they're actually buying the same underlying stock. They might change the weightage a little bit here and there, but in reality, they are buying the same 50, 100 stocks. So they are also basically contributing the same thing. So now one can argue that, so the bigger argument could be that basically too much money is coming into the equity markets. So if you have too much money coming into that market, are we actually, valuing equities much higher than what it should be? Now that's a completely different kind of a debate, not an active passive debate. Same goes for all assets, that basically, too much of money, the money supply is so high and you've created so much money that you're chasing very few assets, equity being one of them. Now that is a different argument, but I don't buy the argument that, basically passive, because the money is going into passive, the stocks are getting inflated to some extent, which are in index. If you are smart, outbid. This is the greatest chance for you to outbid. You can't get a better chance.
Very interesting. So, do you think that markets are finally getting efficient? If I have to draw a corollary from this?
If you ask us, markets are always efficient. I'll give you another example. So, this is around 2007-8. People were talking about, basically, you say India is different, US markets are all efficient, but, Indian markets are very inefficient. You can actually do alpha on that. We obviously gave a lot of research, TRI, and we talked about the TRI part, and obviously, they were couching the fact that basically they were not outperforming and they were doing this. We came out with a research showing that basically if you look at the last 10 years, which is in 2006-7, with all kind of slicing, dicing of returns, most of the active managers were underperforming, or if not wrong word, they were not consistently outperforming, and as a group they were underperforming there. And this was actually published in Journal of Indices. And we looked at the large index and also the mid-cap index at that point. But to be fair, that time you don't have many mid-cap indices, funds and all that. But really we looked at it and we actually published it. So to answer that question, basically the markets are always efficient, even in 2006.
Also, it depends on the composition of market. Like when it's a total market, there's an institutional market, there's a retail market. So if there is an institutional portion is small, then they may have some kind of leeway over the retail. So it might appear to be outperforming because overall market kind of underperforms the index. But as the institutionalized grows, then all the institutions will come into the same bucket and they will have a problem. If you see the evolution of small cap the same thing happened. People were telling that small cap people are able to outperform the market because not many institutions were in small cap. Now, small cap funds themselves are becoming very huge. So the problem for them is coming in that segment as well.
Let me ask you, which is your favorite index? Out of all the indices which are there, which energizes you the most? The mid cap index, the quality index, there's tons and tons of index.
Nifty total return, 500 or total return
Nifty
index.
total return?
Yeah, 700 stock indices. We are like, how many more stocks are, better it is.
So the more diversified the portfolio, the more beneficial.
Yeah, you are
If you
capturing
can
entire
get an
economy.
index which puts in all the stocks which is available in the market, it is the best. Feeling it, Nifty 500 because that has 500 stocks, or BSE 500. Feeling which is tradable. We can easily trade is Nifty 500 or BSE 300.
That's fascinating. As an investor, I can tell you one of my go-to things for ETFs is when I'm unable to decide which stock to buy in a sector. Like defense, for example, went all over the place, and I just couldn't decide what to buy. So I went and I bought the defense ETF. And although the inefficiency is slightly higher there because individual stocks and concentrated portfolio. Just a couple of more questions I think which have been playing on my mind. We talked about the global markets. We talked about the US, your exposure to funds in the US. Which market resembles India the most? Which adjacent market or which market in the world resembles India the most? And if you name that, if you could tell us what we can expect, basis the growth of that market, what we can expect in the Indian markets.
I think Indian markets are unique, to be honest. But if you ask me, number of stocks, I think the US market is the closest. If you look at any other market in the world, the amount of stocks which is listed in India is I don't think it compares at all to any other market except for US. So I would say US would be the country which drives new asset classes into the Indian market. In terms of new, I would say, look, the new asset classes which you talked about, the whole idea of Bitcoins and all that. Obviously, forget the regulatory aspect of it, but the concept that basically you can actually come up with a ability to invest in something which is very difficult to buy is something which will keep happening. And I'll give you another example. We came up with the concept of Hang Seng Index, first of its kind again. We actually marked that basically we'll have trading overlap between Hong Kong and India. The whole idea was that we had about 1.5 or 2 hours of gap, so that overlap, so that basically people get the right price. So any product which gives you access to markets which are basically not available to the retail investor, I think is the next step.
Fascinating. So I hope that one of these days we can crack this inverse ETF code also. I think that's something which I keep hearing a lot of people talking about, that I'm not able to short the market. If I bought an inverse ETF, it would have been very helpful.
But we need proper structures for that. We need to work on that.
Who better than you guys? You've already done that, been there, done that. So that's what it is. I just want to understand one last thing. And this is a question I don't want you to think too much about. Okay, I just want you to respond from the heart. If you were to launch a business today, if you were to make a comeback today, in this day and age when there are apps, there is speed, customer attention is very fragmented, too many choices, how would you build the business? What are the 3 things you would do today?
I would say, again, passive definitely, without exception, because, there's a philosophical belief. Number 2 is basically, again, give access to people to assets which you don't have and structures which you don't have. And third is, I would say, even debt, because I think the debt market is not yet developed in terms of the ability for people to really participate, especially the retail. Debt is an institutional market in India.
So the debt ETF market, the debt market is not developed, or the debt ETF market is not developed?
Because to an extent, debt market is not developed, and because of the debt ETF is not developed. But on the other side, because you don't have too many retail people, the debt market is not developed, and so it's a vicious cycle which we think is ripe for breaking. And if we were to come back, this is what I would do.
No, it's been a fascinating conversation, and I've enjoyed it thoroughly. And it just took me back memory lane because like I said, I've been seeing you from the outside and seeing you grow and seeing you make those amazing product launches. I hope that we get to see entrepreneurs like you. You are a beacon of hope for a lot of people who want to break the mold, come up with something different. And I don't want to use the word radicalized thinking, but revolutionized thinking sometimes in something different. Thank you so much for your time. I will now hand it over to the students in case they have any questions to ask.
Hello, sir. Good evening. My name is Pamta Yadav. So, my question is, what is the single biggest risk that could cause the ETF to underperform its benchmark?
The biggest risk is the fund manager not, if we are talking about equity ETF, when the rebalance is happening, they basically do not rebalance it at the price which at the closing price of the rebalance day. That will be the biggest underperformance.
Okay, sir. Thank you.
My question to you is that in the current market, there are several uncertainties that are happening. So, according to you, what sector in the ETF market would be the safest to invest in?
We believe that basically, we are product providers. We basically design products so that basically an investor can invest very efficiently and without any friction. This is something your financial advisor or yourself would have to determine. Will once you determine, we'll try and give you the best way of investing it.
Okay, sir. Thank you.
In nowadays, youngsters are very versatile. They have less risk appetite and aims for higher returns. So, how do you see passive financial product going ahead?
So it is a word called oxymoron, right? If you want lower risk and higher return, it doesn't mean so. Nothing like that is existing. You want higher returns and you have to take higher risk. So then you go for equity. You can lower your risk by increasing your horizon of investments. So your risk comes down because of that. But otherwise, in short term, you risk are there if you do equity. Otherwise, if you are not risk taker, then you will go for something like fixed deposit or bonds or investments like that.
In the today's world, the young investors, young generation, addicted to the quick commerce kind of thing. Like they need quick returns with less amount invested in. So a message for young investor to go for long term rather than chasing the short term returns or going for futures and options without any knowledge and like.
So I think at this age, I think one is building financial capital and other is building personal capital. But this age, this building personal capital has got huge rewards because then your career will improve, your salary will go up, or if you do some other business, you will do much better. So because your surplus saving is much lower, it's better to build your personal capital right now.
What an amazing journey this has been of two entrepreneurs starting together, coming up with an out-of-the-box idea, it looked like at that point of time, and to build it in a manner which has revolutionized the way Indian fraternity has started to invest. In fact, I'm again very tempted to close with a quote. Way back in the day when they would have launched something, people have said, WTF is an ETF, but now ETF is there everywhere. And more power to you as entrepreneurs, and I really hope that there is a generation of people which will get inspired by you and come up with newer and newer products. Thank you so much for your time.